When most people hear about options trading, they picture a high-stakes casino where traders gamble on wild price swings. But underneath that chaotic reputation snaps into a precise set of mechanical tools designed to control specific market risks. To see why options exist, look at traditional stock buying. When you buy shares, your relationship to the market is entirely linear. If the stock goes up 10%, your investment goes up 10%. Your risk and reward are matched exactly 1-to-1. The problem with that linear setup is capital efficiency. To make a meaningful return on a small stock move, you have to lock up massive amounts of upfront cash. Options solve this through mechanical leverage. Buying stock requires full upfront capital, but a single options contract gives asymmetric exposure to 100 shares for a small premium. The catch is expiration. Every second you battle time decay. Because the clock runs out constantly, the contract's value is highly sensitive. A fast move multiplies returns, but a stagnant stock accelerates losses. Options give you immense power to amplify your trading capital, but they force you to manage an entirely new dimension of risk: time. Every strategy is built from two basic contracts. In this fidelity slide, a call option gives the right to buy an asset. A put gives the right to sell. Notice the dynamic. The contract buyer, the long position, holds the right. The seller, the short position, takes on the legal obligation. Because of that structure, simply guessing whether a stock will go up or down isn't enough to make a profitable trade. To succeed, you must match a strategy to three distinct variables: how far the stock will move, how fast it gets there, and the capital you'll risk. Traders tackle this by falling into three distinct profiles. The speculator wants high leverage and accepts high risk. The yield seeker wants to generate steady upfront income, and the hedger spends money to protect their portfolio. Applying a speculator strategy when you have a hedger's risk tolerance will drain your account before you even understand what went wrong. Choosing a strategy requires defining your market prediction and finding the specific mathematical tool built for that exact scenario. Let's start with the speculator. They rely on long options, meaning they buy the contract outright to secure maximum leverage while strictly capping their total absolute dollar risk. This chart shows a long call, designed for a bullish prediction. You pay an upfront cash premium for the right to buy the stock at a specific strike price before expiration. If the stock rockets upward, your potential profit is technically unlimited. If the stock crashes, the most you can ever lose is exactly the premium you paid to buy the contract. But look at the space between the current price and the profit line. That is the break-even hurdle. If the stock only goes up a little bit, you still lose money. You were right about the direction, but wrong about the magnitude. The long put operates on the exact same logic, just in reverse. You pay a premium for the right to sell the stock at a set price, allowing you to profit heavily if the underlying company's value crashes. This fidelity slide breaks down the actual math of that break-even hurdle. If you buy an Apple 120 call and pay a $4.45 premium, your break-even point isn't 120, it's $124.45. The stock must rise above that exact number by expiration for the trade to be profitable. If the stock stays at 120 or slowly creeps to 123, your option expires worthless. You lose 100% of your initial premium. Buying options guarantees you will never lose more than your initial investment, but because the stock has to aggressively clear that break-even point, your overall probability of winning the trade is significantly lower. Yield seekers take the opposite approach. Instead of buying options, they sell them. By taking on the legal obligation of the contract, they collect that upfront cash premium immediately. This chart displays a covered call. It's built for traders who already own 100 shares of a stock and think the price will remain relatively flat. By selling a call option against those shares, you collect cash today. But notice the trade-off. Your maximum profit is strictly capped. If the company suddenly announces a massive breakthrough and the stock explodes upward, you are legally obligated to sell your shares at the lower strike price agreed upon in the contract. You keep the upfront premium, but you miss out on all those new gains. Another income strategy is the short put. Here, you hold cash and sell a put option on a stock you wouldn't mind buying at a lower, discounted price. You collect a small premium right now, but as the chart shows, you are exposing yourself to massive downside risk. If the market crashes, you are legally forced to buy 100 shares of that stock at the higher strike price. Even if the company is in free fall toward bankruptcy, you have to buy those shares. When you sell options, you flip the dynamic. You act as the casino, collecting premium from the speculators who are betting on big moves. Selling options puts cash in your pocket immediately and offers a higher mathematical probability of profit. But the toll is heavy. You either strictly cap your upside potential, or you expose your capital to severe downside risk. The final profile is the hedger. They already own the stock. They want it to go up, but they fear an impending market crash. Their tool is the married put. You execute a married put by holding your existing shares and simultaneously buying a put option on that exact same stock. This chart shows the result. You establish an absolute mathematical floor on your potential losses, while keeping your unlimited upside growth completely intact. But that bulletproof insurance isn't free. The premium you pay to buy that put option is a non-refundable tax on your portfolio. Because you spent cash on protection, your stock now has to appreciate significantly more than it normally would, just to cover the cost of the insurance and get you back to break even. Notice the exact contrast with the yield seeker. The hedger spends cash out of pocket to limit their risk. The yield seeker takes on risk to generate cash. The married put proves a core law of finance. Achieving total peace of mind and strict risk limitation will mathematically always eat into your total returns. The single fastest way to blow up an options account is applying a strategy that actively contradicts your expectations for the market. If you expect a stock to stay flat and you buy a long call, you will bleed capital as the clock runs out. Even if the stock never drops a single penny, time decay alone will wipe out your premium. To avoid that, you have to map your specific goals to the right mechanical tool. We can trace this on a decision tree, starting with your view of the market. If you have high directional conviction, limited upfront capital, and are willing to lose your premium for a shot at high leverage, follow the path to long options. If you want to turn a stagnant stock portfolio into an active cash stream, and you accept that you'll miss out on sudden bull runs, follow the path to covered calls. If you have cash sitting in your account and you genuinely want to buy a specific stock at a discount, follow the path to short puts. And if you want to sleep well during earnings season or extreme volatility, and you accept that the insurance cost will reduce your profit margins, follow the path to married puts. There is no universally perfect strategy. There is only the mathematically correct strategy for a specific set of circumstances. Options mastery relies on the systematic management of trade-offs to build a portfolio aligned with your financial reality.